Welcome back to the Home Stretch podcast. Today, we're talking all about mortgages with a very special guest, Tay Farrid, who is a mortgage broker. We're going to be running through the mortgage processes, common mistakes, and also understanding products. So, Tay today is going to share all of his incredible insights. Hopefully, it will help you feel more confident in the mortgage process and buying your dream home. So, Tay, welcome to the podcast. Thank you so much for joining us today.
Thank you very much for having me, Elise. Pleasure.
To start things off a little bit, why don't you kind of briefly describe like what you kind of do in the mortgage industry?
Yeah, awesome. So, my job role is a mortgage broker. So, I work with multiple different lenders. So, we're talking high street lenders, specialist lenders, and so on. But I also work under a wealth management firm. So, not only do we deal with mortgages, we also look at financial advice in the form of investments, pensions, retirement planning, and stuff like that. So, currently, I am a mortgage broker, but I'm also looking to study to become a financial advisor. So I feel like I'm in that sweet spot of understanding my mortgage clients, but also maybe looking at them from a holistic approach as well.
Ah, okay. So what would you say the difference is between the two of those in terms of like mortgages and things like that?
Yeah, so with mortgages, predominantly everyone understands mortgages. You're earning an income, and that will equate to X amount in terms of affordability, and then there might be criteria. But when it comes to financial advice, typically that is a much bigger, broader advice spectrum. So, for example, we may have clients who are looking to retire maybe in the next 25, 30 years, and they're thinking, where do I start? What do I do? Where's my pension? Who do I go to? Where is my money invested? All of this stuff. And those questions can yeah, start packing up and so on. So I think with financial advice, the difference is it's a bit more than just your mortgages, say your insurance. It could be the investment inside, say an ISA that you're looking at. And we do like an annual review. So the idea is if, for example, you were to invest some money with us, every year we'd basically go through your investment, make sure it's made a good return, maybe have a discussion around it if it's dropped, if it's gone up, if we need to pivot and stuff like that. And we work all the way through to that retirement goal, or maybe if you wanted to buy your first home and you needed to save a deposit, we could set up an ISA, and maybe after 5, 10 years, we can look at it. Hopefully, you've now got the deposit needed to save, the deposit needed to buy your house, and away we go.
That's really like a really interesting line of work. And l- LISAs and ISAs and all of that sort of stuff is very interesting too. Because I don't know if you saw one of my TikToks went a little bit viral where I didn't read the T's and C's and I opened up a lifetime ISA and I didn't realize I couldn't use it within the first 12 months of opening it up. So, in terms of kind of lifetime ISAs and things like that, do you think that's quite a good route to go down, especially for first time buyers, I guess, to save money kind of earlier on?
Yeah, good question. So there's typically two ISAs that a lot of first-time buyers are looking at. So it'd be the Help to Buy ISA, which sadly no one can get anymore, and then there's a LISA, which is the Lifetime ISA. And the important aspect around LISA is you get two options. You can either have a bonus from the government when it comes to putting down a deposit for your first home, or you could then have a bonus when you're looking to retire. So it's either of the two. Now, yes, there's some terms around it. As you found out, you need to have it going for at least 12 months. You can contribute X amount, so you can't, slap £20,000 in there in 1 year and stuff like that. So there is criteria around it. But from a first time buyer's point of view, it's a great way to get up to 25% in terms of a government bonus if you are looking at potentially saving in the foreseeable future. If you're someone who's thinking of moving into the first home in the next month or two, as you probably know, Elise, bit short notice around that, but maybe in the next 5, 10 years, certainly something to look into for sure.
Yeah, definitely. I think we didn't realize we was going to move into our house so soon, and things, even though there was a delay, things still took quite a lot of time. And yeah, I didn't manage to meet the requirements for that one. But yes, it's a very good way, I think, for people to save money for sure. Because my boyfriend had it for about 6 years, and he used it very well, and he got a very nice bonus that paid quite a lot of money towards the deposit. So it's definitely good. So, what's something about the mortgage world that you wish more people understood kind of from the beginning of the process?
Don't assume you can get a mortgage. And I know I say that with negative sort of aspect to it, but a lot of the time people who want a mortgage just assume that you just go to the bank, you give them some documents and away you go. It it can be as simple as that, and for some potential clients, yeah. But when you've got criteria and some complex income, maybe you've got credit cards, maybe you've had adverse credit, all of this stuff, the only time it actually comes to fruition is when you start applying for a mortgage. So the first thing you need to be thinking about is speak to someone like a mortgage broker like myself, just to sort of iron out any potential hiccups, creases that you could face during that whole mortgage process and home buying process.
Yeah, I think credit checks and affordability checks and things like that, it wasn't something that I was fully aware of until we started looking at mortgages and speaking to a mortgage broker. But things even like Kalana and loans from the bank or just big investments and things like that have quite a big impact, don't they?
Massively, and people once again don't realize. And I think with the problem with Klarna or buy now pay later is it's quite a new form of lending. So what happens is lenders almost have to take a new approach at it, and sometimes a bit slow. So other lenders may take time and think, actually that looks like a payday loan. We don't kind of want that. But other lenders might look at it and say, oh yeah, okay, well they're making it in 3 installments. Looks like they can make those payments. Fair enough. One thing you really need to be looking out for in terms of the credit limit side of things is if you have a credit card, and one of my clients sadly fell into this. He had a credit card. I think the limit was £1,500, and he was sort of spending 1,300 of that limit. And squeaky clean credit report, he's made payments on his car loan, his credit card, minimum payments, and so on, but he just couldn't get the mortgage because of the internal credit scoring that the banks use. And the reason is because they thought he's using too much of his credit card allowance. And how is he going to be able to afford the mortgage with bills and stuff like that on top of that? Is that going to push him further? Is he going to make those payments? So that's something you really want to be looking at is if you got a credit card, unless I know you want to build a credit score and, rather than using your debit card, just use a credit card. Maybe you get some points or perks with that credit provider. But just, yeah, make sure you're not using any more than, say, 50% of the credit limit on that, and at least for 12 months, because they look as far as back as 12 months.
Wow, that's a really good tip and never heard that before. So that's, yeah, really interesting. Thank you for sharing that. So, in terms of the kind of start of the mortgage process, I feel like, especially for first time buyers that have never done it before, it can feel quite overwhelming. It can be quite stressful. You've never spoken to a mortgage advisor before, so you don't really know what you're supposed to be talking about or that sort of thing. What would you say is the very first step that someone needs to do before they're even thinking about getting a mortgage?
First step, and this is getting a lot more common now, is people are actually engaging with mortgage brokers before they start viewing properties. So ideally, you kind of understand what deposit you've got because you look at your savings account or your help to buy ISA or LISA or whatever. You look at your income and you might think, yeah, I could potentially borrow X amount of money. But until you get a decision in principle, mortgage in principle, agreement in principle, they all mean the same thing. Until you get that, you're not, you can't almost assume because, like I said, there could be some hiccups along the way that you may not have known about. So the first thing that a lot of buyers want to be doing is engaging with a mortgage broker, or if they want to go direct to their bank, they can obviously go and speak to their bank. With the mortgage broker, we'll be able to access obviously a fair few different lenders out there. So you don't have to go out your way to go to 10, 12 different lenders or so trying to find answers. So, number one, fundamentally, decision in principle, work out your affordability, make sure that you've got no hiccups with your credit score, anything like that. And then you can slap your deposit on top of that affordability. And away you go. You've got now a bracket of properties within that, price range. And what you could do is you could even maybe put up the price bracket 10, 15,000 pounds over, because of course there's room for negotiation, which maybe we'll discuss along the way in the podcast. But yeah, that's the first thing I'd say.
Amazing. So it's interesting you talk about kind of agreement in principle, mortgage in principle, that sort of thing. When it comes to viewing houses, does that mean you don't technically need a mortgage in principle to kind of view houses, but you need one for when a sale gets agreed? Like, what's the kind of duration or like that kind of process side of things? What's
Yeah.
your take on that?
So in black and white, you don't necessarily need the decision in principle per se. It does put you in a much better limelight if you're a first-time buyer who's got your eggs in, aligned or whatever. So the idea is if you've got that decision in principle, you can, in theory, show the estate agent and say, "Look, I can purchase this property, and here's the proof for it." But you don't necessarily have to show your cards to the estate agent. It's kind of that, do I trust the estate agent to give my decision principle? Because then he might know how much I can go up to, blah, blah, blah. I mean, I've heard all these sorts of interesting stories. But typically, the point where most agents want to see some kind of proof is once you've had an offer accepted. So that is, you view the property, you've not even shown a decision in principle, but now the offer's been accepted, and rightly so, the vendor does want some certainty that, this potential buyer is able to purchase my home. We don't want time wasters. The longer the property's on the market, the less likely it's going to look appealing. So you kind of have to weigh the options. So we call that process substantiation. And the idea is, the estate agent, I should say, is the ones who basically stamp the offer and say, yes, Mr. Vendor, we've vetted your buyer. They've got the mortgage in principle sorted. They've got the conveyances ready, and we've seen proof of deposit.
That's really interesting because, yeah, I feel like we got our mortgage in principle before we even started viewing houses. And I think for us, it was kind of good to see roughly what we could afford, how much repayments would be on a certain house value. And yeah, I think it's just quite good to see before you start viewing houses, because the last thing you want to do is view a house that you love and then find out later down the line that you can't actually afford it. So yeah, one of those things. But in terms of then kind of affordability and credit checks and things like that, do you think there's anything else that first time buyers or buyers in general should be aware of or should keep track of or not do, within those 12 months before looking and viewing houses and things?
Yeah, I mean, this is a bit of a complex area when it comes to income and affordability. So I'll try and keep it entertaining, all right? I'll do my best.
Perfect.
So basically, when it comes to affordability, many different lenders will view your income in different ways. So 9 times out of 10, well, actually 10 out of 10, if you've got a basic income, permanent contract, and you're earning X amount every month, it doesn't change. That lender's going to use 100% of that income, and they'll multiply it by, say, 4.5 times, as a quick rule of thumb. When it starts getting complicated, it's all to do with your variable income. So sometimes people get commission, overtime, bonuses, maybe even dividends. There's so much other income complexes that come into the equation, and different lenders view that differently. So when I'm having conversations with my client, the first thing I need to assess is, what is the amount they want. So if it's a £200,000 and their basic income covers that amount to borrow, then I don't really need to find different lenders out there who's going to worry about the commission, the overtime, the bonuses, right? It's only when someone's looking to stretch their affordability and they're wanting to utilize the additional income that they receive. Sometimes people have universal credit, child benefits, and so on, and they want to add this all into the income pot and be able to use it. And not every lender, like I said, will be able to use it. Some might even just use 50% of the additional income. So the process behind it is, it can be a bit complex, but it is, of course, to the client's need. I had a client who had loads of additional income, but his basic income covered the amount he wanted to borrow. So rather than me trying to find a more sort of specialist lender with a slightly higher interest rate, I used my head for once, and I thought, well, actually, he could go to a high street lender. Affordability is very comfortable. happy days. And that's what we did.
Love that. Lovely story. So, in terms of your role in your industry as a mortgage broker and people going to their bank, what is the difference then? Because we never even thought to go to a bank. We went to a mortgage advisor, someone who was recommended to us, but we never even thought to go to our bank. I didn't even know that was a thing.
Yeah, it's funny that because it's either or. So some people will start off with the bank because they think it's a safe option. They bank with them for umpty amount of years. Let's just start there. And then some people they've probably done a little bit of research or they've had a recommendation like you have from one of your friends. So the difference between myself, a broker, compared to a mortgage advisor is a mortgage advisor only works with one bank, i.e. Nationwide or Barclays or so on. So you'd go to that bank, you'd speak to their in-house mortgage advisor, and that advisor would only talk to you about nationwide products, nationwide criteria, nationwide affordability, and everything all hunky-dory around nationwide. Fantastic, right? However, as you probably are aware, there may be an ample amount of other lenders out there who might have better rates, maybe more suited to you, maybe the application process is more smoother, maybe the property you're buying, they prefer that over nationwide, because that's another element in itself about valuations, which we could get into. But yeah, ultimately, you come into a mortgage broker instead, almost just saves you that time. Because if you think about it, you go into a bank directly is going to take you maybe an hour to 2 hour appointment. Okay, so it is a rigorous one, and they'll go through a proper fact find and all of that jazz and documents and blah blah blah. And after those 2 hours, they will say yes or no. Okay. And if it's a no, you'll feel so deflated because that 2 hours you could have been in bed or whatever you were doing, right? Whereas when you come to a mortgage broker like myself, I'll be talking to you about other aspects and okay, yeah, we're gonna have to go through the fact find, but you'll only have to do it once with me. I've got all the information, I've got context around you, and then away I go, sourcing the relevant mortgage with the right affordability, with the best rate that I could potentially find you, and we've banked that and ready for you to go ahead and start viewing.
Yeah, I love that. I think we definitely got a lot of information from our, mortgage broker, and they kind of gave us like a really, really long list of different lenders and the different rates and the different, if you do 30 years or 35 years, this is the difference. So in terms of like interest rates and things like that, I don't know what is currently sat at the moment, but have you kind of saw any kind of trend in the market? If are things going like up, down? What's your take on kind of like the trends in the market right now, the housing market?
Yeah. I'm glad you asked that because I'm one of those saddos who just looks at rates. And one of my guilty pleasures is when I see a rate reduction with a bank that I've placed a mortgage application with, and then I can switch to a lower rate for my client and save him some money. So, as an example, yesterday, Nationwide reduced their rates further, and my client hadn't exchanged contracts with the seller yet. And as a result, I just switched them to a lower rate with Nationwide, saved them about £760 over their term. So of course they were loving that, and so was I, because that's something that I'm giving back to my clients, which is fantastic. When it comes to trends, if I bring you back to 2023, where sadly Liz Trust messed up the mortgage market, and that was a bit of a tough day for us all. Rates were sky high. I mean, 6% plus. They were ridiculous. It really did slow the market down, and I do feel the market is still not fully recovered. I mean, there's properties on the market, but there's just not enough buyers, and it's currently a buyer's market. Now, what has happened in the last 2 years is banks have been really trying to figure out ways to push buyers back into the market and to try and help them as well. So, one of the biggest things that banks will try to do is stay competitive and to reduce the rates, because they know if they've not reduced their rate, but the bank next door to them has, well, they're going to lose that business, because most mortgage brokers will just place you with the best product available at the time of sourcing, right? So, in terms of the trend around interest rates, they were ridiculous, like 6% a couple of years ago, but they've now gone to sort of 5% for a 5% deposit, all the way down to about 3.8, maybe 3.7% if you've got a 40% deposit. So we've got a real good margin there, yeah. So there's hope, basically. first time buyers, sadly, with a 5% deposit, you're still going to have to fork out, maybe 5%, maybe the low 5% on terms of repayments on the interest rate. But it's a lot better than where it's come from.
Yeah, for sure. I feel like it's slowly, I don't know, it's kind of helping first time buyers get on the property ladder a little bit, being able to have like lesser percentage of deposit. So ours was 10%, we put 10% down. And to be honest, we couldn't have done any more. But yeah, even that was really good. I think our interest rate at the end is maybe 5.25 or 5.24, something like that. But we're talking we started last August and then fully completed this Feb. So yeah, it's kind of good to see that rates are slowly getting a bit lower. In terms of product fee and that sort of thing, can you explain a little bit about what it is, how it works? Because I feel like as a first time buyer, I struggled to understand it. We actually got stung with the product fee just before we completed. So we thought it was going to get put on our mortgage. And then about 3 weeks before we exchanged, our solicitors said, oh no, you have to pay for that now. And it was like £999. So we had to pay like an extra grand just before we moved in. So
Ooh.
yeah, can you explain a little bit about product fees, what they are and things like that?
So this is something that a lot of first-time buyers almost get caught out with because they're thinking a product fee, never heard of it. What is that? In terms of jargon, it could be called product fee, it could be called arrangement fee, lender fee. It's all the same thing. So typically, the way the banks position this is they'd give you a product with a product fee at a slightly lower interest rate or a product without a product fee at a slightly higher interest rate. Okay. So this is where the broker skills now come in. So what I would do is I would assess which product over the fixed term is better suited in terms of overall cost. Okay. Now, so far, 9 times out of 10, and by the way, this is an advice, so you should obviously do your own calculations. But the product with the product fee usually is cheaper over that product term. Okay. So then you can either add the product fee onto the mortgage balance, like I think you were anticipating to do, or you can pay it up front. So let's tackle that. If you add it onto the mortgage, what'll happen is you save yourself £1,000 coming out of your pocket from the day before you complete, and that must have hurt. But what happens is over the mortgage term, you will incur additional interest on that extra £1,000 that you've borrowed. So over 25, 30 years, all the way to 40 years, that could start racking up a nice bit of interest, right? So if you can pay up front, it means that you've got yourself a better rate, monthly payments are still lower, and you've also, yeah, paid off the £1,000 to avoid accruing interest over the mortgage.
That makes so much sense. And like in hindsight, I'm very glad that we've done that now because it's something that we don't have to think about. So yeah, I definitely think it was the best decision. At the time, not so much, but now, yes. So in terms of kind of common mistakes and like potential red flags and things like that, what are the three common pitfalls you often see first time buyers kind of make?
Oh, um, one of the biggest ones is just assuming. Say, for example, they've not looked at the credit score since God knows how long, and they've just not thought about a mispayment they've made or some kind of blip in their credit history. So always look and make sure you've got a nice, good credit score. I mean, it's not the end of the world if you made a mispayment or two, but ideally you kind of want to be in a good position from the credit score point of view. The other misconceptions could be stuff like you need to make sure that you've got a 5% or a 10% or 15% deposit, like in increments. You don't necessarily have to have it in those brackets. You could be anywhere between 5 to 10% in terms of deposit. You could be anywhere between 10 to 15%. You don't have to like stretch to the next 5% increment. But what it does mean is if you fall within the bracket, you will still only get the product available for the higher bracket, if that makes sense. So just to explain that a bit further, if, say, for example, we had a 7% deposit, you're still only going to be able to get products available at a 5% deposit rate. for example. So that's something else that some people sort of miss out on. Other assumptions is that you can only get a mortgage for 25 years. That was a myth that I think is starting to change a little bit more. A lot of buyers are now actually moving towards 40 years just to help with their monthly repayments. It's sad to see, but I think it's kind of one of those things where for now, if that's going to be able to help you maintain your monthly payments, we can always revisit it at a later stage maybe. But 40 years is becoming almost a new norm. In terms of fixing your products, we've got loads of different terms in terms of product years. So it could be 1 year, 2 year, 3 years, 5 years, 10 years if you wanted. We've got tracker rate products. So a lot of people may not even realize that you can actually track the Bank of England's base rate instead of just fixing your interest. So that's more of the advantageous clients, the ones who sort of are looking for slightly higher risk. So it's not for everyone, of course.
I guess going back to that point, are you kind of talking about a variable rate versus a fixed rate and how like they're different?
Correct, yeah. So when it comes to variable rate, you've got obviously the standard variable rate, which no one really wants to go on. That's just basically after your fixed rate comes to an end, the bank just slaps on 2.5% on top of the Bank of England base rate or whatever it is, and it could go all the way up to 7, 8%. Who the hell is going to want to pay that? Not me. Or you could do what we call a tracker rate, which is a type of variable rate. And what it does is it tracks the Bank of England's base rate, but it will add, say, 0.18% on top of the Bank of England base rate. So that if someone's anticipating that the rates are going to fall with the Bank of England, then you might benefit from a rate reduction over, say, the 2 years that you've gone for that product.
God, that sounds so complicated to me. Like you have to watch the news all the time, every day, every month. And because I guess it changes so quickly and it's like you have to be on the ball. Otherwise, you could be paying like loads of money. So, in terms of remortgaging, and let's say a 2 year fixed rate mortgage has come to an end, and you need to remortgage on a house, how early in advance do you think people need to like start looking into remortgaging and how does it even work?
Yeah, so this one, remortgaging can feel like it's a long time away, but honestly, it comes by so quickly. So what you really want to do is as soon as you know when your fixed rate is coming to an end, you want to be speaking to your mortgage broker 6 months before and entertaining a new conversation around your mortgage needs. Because in those 2 years, things may have changed or things are still hunky dory. You know, you're still in the same job, still earning the same amount, nothing's really changed, right? Or you're now thinking of doing an extension and all of a sudden you need to borrow an additional £50,000, for example. So things like that is we need to ascertain what we need to do when it comes to your remortgage time. So 6 months before, we'll have an initial conversation and we'll assess what the rates are looking like at that time. Now, most banks won't allow you to secure a new rate until maybe 4 months or 3 months before your fixed term comes to an end. So, as an example, say your current fixed rate deal is coming to an end at the end of this year, so 2025 December. We could have had our first meeting in June. We could have had a conversation, checked rates, what they're looking like. Are the monthly payments going to be hard for you to maintain? Are you still going to be comfortable? Because you obviously got to make sure that if monthly payments are going to go up, how are you going to be able to afford those, right? So we're almost like helping you out with that payment shock. And then when it comes to the product transfer window of that, say, lender that you currently have your mortgage with, we could look to secure a new fixed term deal ready to switch from the 1st of January 2026. So, what you've essentially done is you've secured a new rate so you can breathe a little bit, knowing that if rates go up between the 4 months and end of December, it doesn't matter because you've got one ready to switch over for January. But if rates fall, which is a possibility, we could potentially switch you over to a lower rate, like I did for my client yesterday, and save you even save you more money coming from January. So that is what we call a product transfer for a lender that you currently are with. So when a mortgage broker is talking to you about a product transfer, it's to do with you sticking with that same bank and just switching your deal over for when it's meant to start. Remortgaging is a term we use for completely moving you from, say, Nationwide to Barclays. There's a new process, new mortgage application. We've got to go through all of your documents again, almost like another mortgage assessment. And hopefully, if the rates are better, it's not a bad thing to do. We would assess whether it's worth you doing it because there are some additional fees that are associated with remortgaging compared to just doing a product transfer.
Yeah, I guess would you have to pay for the mortgage, the product fee again for the new
Potentially.
yeah, so that's an extra grand. That wouldn't be nice
And a
potentially.
conveyancer fee.
No, thank
You
you.
have to pay a conveyancer fee, yeah, and that would
I'm
cost you
good.
probably 300 to a grand, but depending on how much they are, yeah. So it's not
It's
for everyone.
it's a lot of money, and I guess it has to be worth it, and yeah, overall for that to happen for sure. So, what would you say is kind of the most overlooked cost when people are kind of buying their first home? Because I feel like a lot of people, first time buyers, really probably don't understand different, things you need to put money into, like solicitors and things like that. What would you say is the most kind of overlooked cost?
One of the biggest ones would be the conveyancer fees, because I've seen some stories where conveyancer would give you a nice initial quote and then all of a sudden they start racking up the extra bits and bobs which you didn't even know existed in the first place, and you're like, hang on a minute, like where's these fees coming from? So that's one of the biggest things that pop up during the house buying process, and also stamp duty. So a lot of first time buyers, some of them are buying properties worth over £300,000. So just be mindful that the stamp duty has changed the threshold. So I've got a client now who yeah, just is buying a £400,000 property, and sort of didn't realize stamp duty changes had occurred. So we had to calculate the stamp duty, and luckily she had that amount still in her savings. Otherwise, that would have, shattered her first time buyer dream. So yeah, conveyancer, stamp duty fees. You've got mortgage broker fees. So someone like myself who charges a fee. Always make sure you get that fee up front, and what is it going to be? When are they going to charge you for it? Is it refundable? This, that, and the other. So that's really important to know. You've got the lender's fee, as you know, the arrangement fee and stuff like that, which you can pay up front or add to the mortgage loan. There's a transfer fee. A lot of people think, what is a transfer fee? So when you're transferring over £20,000 from one UK bank account to another UK bank account, you need to use a system called CHAPS. Okay. And what CHAPS is kind of like a fancy system that does quick checks to make sure the money gets sent to the right place. Okay. And there's a fee for that. Now, it's not going to cost you an arm and a leg. I think it's like 25 quid or maybe a bit more. But what the conveyancer does is they do that on your behalf, but they'll charge you a bit extra because they've had to do the admin on that. So it's
Hmm.
a bit of a pain because like it was 25 quid. Why the hell is it 45 now? Like stop just pushing it up. So that's the other thing. And then the last thing a lot of people don't realize is the bank has its own conveyancing needs that your conveyancer needs to fulfill. So your conveyancer will have a quote for the legal work that they will do for you, but the bank will also need some legal work doing for them, and you will bear the burden of that cost, and that will come to you. Hopefully they give it to you in the quote, and if they don't, it'll cost you anywhere between 300 to say 900 and plus
Wow.
extra.
A lot of extra costs with that. I mean, I didn't have my eyes fully open when we were even viewing houses because I think in my mind, you just kind of focus on the deposit and you're like, well, as long as I save the deposit, that'll be fine. And then when you actually start researching about how much it actually costs to buy a first house, it adds up very, very quick. And, we were very, very lucky in our circumstances because we exchanged and completed in February this year. And the stamp duty changes came in March, I think it was this year. So we
Yeah.
missed it by about 1 month. So I was like,
Ooh.
we better complete. We are not paying an extra like 6 or 7 grand. It was going to be. It was going to be so much
Wow.
money.
How much did you buy for, if you don't mind me asking, or just a
Yeah.
range?
No, it's fine. So our house was on the market for 425, but we got it for 418. So we got it below the asking price. We went £10,000 below. So we went in at 415, being a bit like cheeky, but also if you don't ask, you don't get. And we negotiated a little bit. And yeah, we actually used the fact that we were first time buyers very much to our advantage. And I think that is such a sweet spot position to be in for people that are looking to buy a house. Like being a first time buyer, you are one step ahead of someone who already has a house, I think, because probably going to be an easy, quick ish sale. You're probably living with family, you're probably renting. But yeah, we got it for a fairly decent price. But if the stamp duty changes came in back in March, we would have had to pay stamp duty on what, £118,000, and that would not have been fun. So,
Good point. Yeah.
yeah, not great. So, in terms of kind of mortgages and stuff, do you tend to see quite a lot of people be accepted for mortgages or rejected? And if people are rejected for mortgages, why? Why is that?
I get a plethora of that. I get some highs and I get some lows. I mean, this morning, sadly, I spent nearly 3 hours just trying to get a high, and it was just low, low, low. So,
Oh,
yeah, with this job, you really gotta you
it's a
gotta
lot.
yeah, a lot of excitement needed, because sometimes you don't get the outcome you want for your client. And I think you get really invested, sometimes emotionally, because you really get on with your clients and you want them to get that property, and for it to be smooth sailing and whatnot. But typically, affordability has been an issue ever since rates shot up to the sort of 6% mark, and then now they've started to come down. But what happened was, at that time, stress testing, which is what lenders use as a overall rate to determine your affordability against, was quite high. So what that meant was people weren't able to borrow as much as they were able to during the sort of COVID times where interest rates were 2% and below. So all of a sudden, we've got buyers wanting to borrow £200,000, but they no longer could afford that because of the current interest rates. So yeah, 9 times out of 10, that was one of the biggest pitfalls when it came to affordability. We've got self-employed applicants. A lot of my clients are self-employed. I work typically with business owners and sole traders, and they sometimes don't have 2 years full accounts. Maybe they've had a dip in the latest year, so their net profit after tax, for say limited company, isn't looking as good. Maybe they've not paid themselves enough in a salary and dividends format, so the lenders think on paper that actually they can't afford it. But if you look at their net profits in their company, they've made a very healthy profit. So it's about sort of navigating the criteria that different banks have and trying to match that criteria to the best of your ability to that client. So yeah, hopefully that gives you a flavor.
Absolutely. That kind of leads me on to my next question about, I guess, people that are self employed. It's very different, I think, when you're in full time employment. It's easy for a bank to kind of tick that off the checklist. And I guess if you've been working there for like 3 months, or would you say you've had kind of clients that have started a full time job fairly quickly and been approved for a mortgage? Have you seen that?
Yeah, so when it comes to employed, if you've got a permanent contract and you're about to start your job within 3 months of you submitting an application, you should be safe. It's only if, for example, you've just started your full-time job or you've just started employment, you've got no track record of previous employment, and you don't even have a permanent contract, it's say a fixed term contract for 12 months, you're going to struggle. So yeah, if you've got a permanent contract, 9 times out of 10, most lenders will be happy with you. You might need, say, 3 months, you might need 6 months of continuous employment just to satisfy that criteria with most lenders, but there are some that you could just. I had a junior doctor. She started a job yesterday. We submitted her mortgage application last no actually a couple of weeks ago, and it got approved within 24 hours because we had the contract from the NHS. So she's a junior doctor. She was a student before, so no previous employment history. And they understood that, hang on a minute, junior doctors are well sought after. She's not going to have an issue with trying to get a job thereafter. So the longevity of her being a junior doctor to senior doctor and so on is comfortable for our risk appetite. Here you go, there's your mortgage offer.
Yeah, so interesting. And for people that are self-employed, let's say someone doesn't have 2 years worth of books, would there be lenders that accepts one or that sort of thing?
Yeah, I really like this question, and it's because I have a lot of empathy for my clients who are self-employed. And one of the reasons why I do is because I transitioned into being a sole trader from September 2024. And in the process, I was actually thinking of upsizing because my house currently, I'm just getting a bit too small for it now, and my little kids running around everywhere. It's driving me mad, but that's a separate conversation. So I'm looking at upsizing, and I realize that hang on a minute, I'm going to struggle to get a mortgage because I don't have 2 years accounts. I could technically go to, and so I started to do some research, and I was thinking, well, come on, there must be something out there. You can't penalize self-employed individuals, and there are some lenders out there who will look at just 1 year's accounts. And there's some lenders out there who will look and see that you were previously employed as a mortgage broker, which I was, to then transition to a self-employed mortgage broker who's sort of earning similar amount or maybe a bit more. Let's be a bit, pragmatic about this. Sounds like, his income's roughly the same. So there are some lenders who will entertain it. But as a general rule of thumb, 2 years is the sweet spot, but they'll average the last 2 years typically as your net profit. So if 1 year you earn 20,000 and then the latest year you earn 10,000, some lenders will do the average, which is 15,000, or some will be really penalizing and just do 10,000. And you're like, "Ah, you cheeky buggers." So yeah, that's a problem.
Oh, it's so tough, isn't it? It's so tough. So, buying in today's market, what would you say is your take on buying a house in 2025? And are there kind of big opportunities for that buyers should be aware of? Do you think?
Fundamentally, I believe that it is a buyer's market. Now, previously, the last few years, it was a seller's market and people were outbidding each other and prices were being inflated and so on. And one of the main reasons for that is because interest rates were low, people could borrow more, there was a big demand, and therefore property prices were going up. However, the tables have started to turn, and there's a lot less buyers and a lot less first time buyers in the market, and we're seeing a lot of price reductions. So one of the things you need to do as a first time buyer is to utilize that buyer's market. So you could go in and you did something similar where you offered £10,000 below the asking price and you saved yourself 7 grand, right? Which is great. Whereas say pre-COVID time or around COVID, I don't know if that you'd be as lucky, right? So when it comes to the property market, is yeah, if you're a first time buyer, you've got your deposit saved up, you can afford your monthly mortgage payments, and you can get the mortgage you need. And if it works for you, entertain it. No harm in having a look, because who knows in the next year or two or so if the tables turn and all of a sudden your deposit could have got you the £425,000 property, but because property prices are going up again and you haven't saved enough in terms of deposit, you're now going to have to fork out or wait until you can afford it, right? So that's one thing. The other thing is, I've done a bit of research in regards to property prices and sort of the appreciation of property prices over the years. Now, they've not grown as quickly as they were during the sort of COVID times and so on. So I think Rightmove said, in terms of year on year from last July to this July, property prices have actually declined slightly on average. Yeah, and I read an article apparently that there was going to be a house price crash coming, and I put that on my TikTok, and it's the first viral video that I got loads of comments for. Luckily, they weren't hateful comments because it wasn't from my mouth, and it still isn't from my mouth. I was just a messenger, so don't shoot the messenger. But they were just saying that there's going to be a property price crash because the landlords are now selling up because the Renters Reform Act, and it's causing issues for landlords and it's not as incentivized, blah blah blah. And now all of these landlords are selling up, pumping properties back into the market. Now supply is almost going up, and not enough buyers still. So there may be some other landlords who are going to sweep that up and maybe look at that from an investment point of view. Or there might be some buyers like yourself, first time buyers, who are like, actually, now it's my time to shine. Let's see how we can do in negotiations. So I would say do your research, look at your local market, make sure you're looking at estate agents. Even if you just want to have a chat with an estate agent, I'm sure they're happy to sort of tell you, look, we've got properties coming on the market. They've been sat on the market for X amount. You could potentially negotiate, like, get some feelers out there. There's no harm in talking.
Mhm. Would you say that most of your clients are first-time buyers at the moment?
Mixed bag, yeah. I couldn't give you a percentage, but I could say on average, I have a good amount of first time buyers, but I also got remortgage clients because at the moment, like I said, because the market is quiet, we're not seeing as many first time buyers, but
Mm.
we're seeing a lot more remortgage clients because everyone wants to get a better deal at the moment because interest rates are a lot higher than they were used to 5 years ago. They were on 1%, and now all of a sudden they got to pay 3 or 4%. So of course people are like trying to trying to secure a better deal.
Yeah. So, in terms of interest rates, do you think they're one of the main things that kind of first time buyers should focus on when they're looking for a house? Or do you think there's other things that they should sort of factor in as well?
Yeah, I mean, that question is always asked by a first time buyer. What's the interest rate if I put a 5% deposit down, blah, blah, blah. And it is such an important question because typically that's what you sort of imagining your monthly payments to be around, and is it affordable and stuff like that. The thing about interest rates is, as you've seen, they can change, right? And the problem is people like myself who've managed to fix an interest rate around 2% before they shot up, is I'm used to that low interest rate. So when I go and remortgage in 2027, fingers crossed rates fall by that time, but I'm going to be like, oh my God, this 4% interest rate sounds really alarming. Whereas a first-time buyer doesn't have a comparison, right? It's they've not felt that monthly repayment on a 2% interest rate. They're going to feel it on, say, a 5% interest rate. So the idea is if you can maintain your monthly repayments on a 5% interest rate, and if rates fall, which they have been over the last 2 years, if you were able to afford 5% and now you're going to remortgage to 4% or somewhere lower, and now you've got money back in your pocket, what was stopping you from actually entertaining the 5% in the first place? Because now you're actually in a better position than someone like myself who was in 2%, had some disposable income that I've been spending on my haircuts and all of that. And now all of a sudden, remortgage down the line, I've got to now fork out an additional £300 per month. That's only one haircut a month for me. So I'm going to feel it more than you, aren't I? So it's kind of like, don't just think interest rate is the be all end all. There's so many other factors out there that you need to be thinking about. You got to think about the overall mortgage term. Do you want a 40-year term? Do you want to pay off your mortgage until you retire at age 70, for example? Do you want to look at a product fee, as you mentioned? Do you want to look at affordability? Do you want to ethical investing? A lot of clients sometimes want to make sure they go with a bank that they feel have good core values. So Nationwide, for example, this is just personal sort of feedback. Nationwide has had some really good limelight in the news because they've been helping out their members, giving some money back to them because they're not a bank, so they don't have shareholders to give profits back to. They give it back to the community, things like that. So there's, yeah, bit more than just rates. I went on a massive rant there, but you can see it's not all about rates, all right?
Yeah, not at all. No, it makes so much sense. There's lots to it. There's so much to it. So, in terms of like things that you've experienced then within your industry, have you ever worked with a buyer that's had a very unusual kind of situation? And if so, like how have you dealt with that?
When it comes to a first-time buyer, I've had quite a quirky one. So first-time buyer, mum is renting at the moment with her best friend, and as a result, she she basically wanted to move in with her daughter, and her daughter was the first-time buyer wanting to buy a property. So she had a so the daughter didn't have a deposit, but the daughter eventually wanted to move and own a first home. And they didn't think that they were able to sort of get mum to give the deposit and then mum to still live in the property with the daughter, and now daughter has a first time home, and that happened. And when they sort of went through the process and they got the mortgage offer, and I think they're very close to exchanging, they were like, oh my god, like how do we, why were we so scared to think that this was an issue? So I think anytime you're sort of worried about something, speak to someone who's in that realm, and who can give you that advice, because sometimes there's no issue with it, like it could work, but you don't ask, you don't get. So that was one quirky thing. And I get loads of other quirky things where a property is near a railway station or opposite a pub or things like that, or near a little river stream, that the lender's like, oh my God, it could be a flood risk area and stuff like that.
Oh, so much to it, isn't there? So much to it. Yeah. Buying a first house is a pretty big deal. At the end of each podcast episode, when I kind of bring a guest on, I want to ask a specific question to each one. So the question is, if you could go back in time and give your younger self advice when buying a home, what would you say?
Wow. You're gonna strike an emotional reaction at me. I'm gonna start being tearful.
Really?
No,
Oh,
it wasn't that bad.
I was like, we don't know each other on that sense yet, Tay. I'm
No, we're
like, are
not
you
on that.
joking or?
No, no. Well, to be fair, when I did go through the house buying process, I was absolutely blasé and naive. I had no clue about conveyancer, mortgage in principle, all of this stuff. It's actually why I became a mortgage broker in the first place. Um, my advice would be is, if you don't know anything, just ask. Don't feel like someone's going to think you're stupid or anything like that, because now that I'm a mortgage broker, I understand more or less everything mortgage related, right? But if you ask me to fix a car, ain't got a Scooby Doo. So it's about knowing you're not going to know everything, and that is totally fine. And when I speak to first time buyers, I have a lot of empathy, because I obviously went through a similar process. And I actually prefer when they ask me more questions, because it shows that they're comfortable enough to speak to me and ask me about these questions. So my advice to Tay, back in 2020 actually, when I bought my
Wow.
house. Wow, I know,
COVID,
gosh.
COVID times.
I was a COVID buyer. COVID buyer. It's done. It's buy during COVID, because actually I managed to get a good deal. But I think biggest thing is trust your gut. If you feel like it's time to buy and it aligns with everything, and you're ticking most of your boxes, you might not tick every box, and that's okay. You're not always going to get your dream home. As a first time buyer, we rarely do. We want a mansion with 9 bedrooms and a hot tub, right? Ain't gonna happen unless you're a millionaire or got inheritance or whatever.
True.
So if it ticks your boxes, you see yourself living there for 5 to 10 years, for example, so you made a bit of equity back, just go for it. Speak to someone, make sure you covered all angles, and just roll with it.
I love that. Great advice. Great advice to Tay back in 2020 when you bought a COVID house.
I
Love
love
it.
that.
Well, Tay, thank you so much for your time today. I feel like I've learned so much information that I'm going to take away, especially about sort of remortgaging, because that will be something we're going to do at some point. So thank you for sharing some incredible things. I know that everyone that's listening to this is just taking on so much information and, very useful stuff, especially for first time buyers. So thank you very much. Appreciate it.
My absolute pleasure. Appreciate your time. Thank you very
Yes,
much.
thank you. We will definitely see you on the podcast on another
I hope so.
episode. 100%. Thank you so
Love
much.
that.